This is a demonstration of exercise 820, accounting for uncollectible accounts using the allowance method, percent of receivables, and reporting receivables on the balance sheet. At January 1st, 2024, Hilltop Flagpoles had accounts receivables of $28,000 and allowance for bad debts had a credit balance of $3,000. During the year, Hilltop Flagpole recorded the following transactions for January, and the problem gives us the transactions for January that affected accounts receivables. In the first requirement, it asks us to journalize Hilltop's transactions that occurred during January, and the company uses the allowance method. So in Part A, it states that Hilltop had sales of $185,000, $164,000 were on account, and $21,000 were for cash. So to record this entry, we would debit accounts receivables for $164,000, debit cash for $21,000, and we would credit sales revenue for the total $185,000. Next, in Part B, it states that they had collections on account of $135,000. So we would debit cash for $135,000 and we would credit accounts receivables for $135,000. And then in Part C, it states that the write-offs of uncollectible receivables were $2,300. So since Hilltop uses the allowance method, we would debit allowance for bad debts for $2,300 and credit accounts receivables for the same amount. In Part 2, it asks us to post Hilltop's transactions to the accounts receivable and allowance for bad debt T accounts. So we already have our T account set up with our beginning balances of $28,000 for the accounts receivable and $3,000 for the allowance account, and now we will post the amounts from the transactions. So first we will post a debit to accounts receivables for the $164,000 of credit sales, and then we would post the credit for the collections of $135,000. In the C part, we had the write-off of the $2,300, so when we post that, we would have a debit to the allowance for bad debts and a credit to accounts receivables for $2,300. In Part 3, it asks us to journalize Hilltop's adjustment to record bad debts expense, assuming that Hilltop estimates bad debts is 10% of accounts receivable on January 31st, 2024, and then to post the adjustment to the appropriate T accounts. So when we use the percent of receivables method, we take the amount that is in the accounts receivables and we multiply that by the 10%, and that gives us $5,470. But we also have to subtract the balance that is in the allowance for bad debt. So after we subtract the $700, we would have an adjustment to the allowance for bad debts of $4,770. So to record the adjusting entry, we would debit bad debts expense for $4,770 and we would credit the allowance account for the same amount. Now we will post those amounts to the account. So we would debit bad debts expense for $4,770 and we would credit the allowance account for the same amount. And now you will see that we do have a balance in the allowance account of 10% of the balance in the accounts receivables. In Part 4, it asks us to show how Hilltop Flagpoles will report net accounts receivables on its January 31st, 2024 balance sheet. So we have a partial balance sheet completed, and we are going to record the gross amount first of accounts receivables for $54,700, and then we're going to subtract from that the amount in our allowance account of $5,470, and that gives us a net amount for accounts receivables of $49,230. And that is the conclusion of the demonstration for exercise 820.